So how do the moves in the bond market and the Treasury intervention mean for the Federal Reserve? Does it put more pressure on them to lower rates? Joining us now, Esther George, former Kansas City Fed President. Esther, great to see you and great to get your thoughts on this. What is your take? Because even if yields come down a bit, I mean, the issue here is the national debt, it's the deficit, it's the funding costs behind it, and yields are still fairly high, even if they are going to stabilize, let's say, from here because of these repurchases.
Yeah, I think, Melissa, since the last FOMC press conference, we've seen the markets really trying to sort out a number of issues. First of all, trying to sort out the Fed's communication at that press conference relative to the fact that we have elevated inflation in this country. It's persisted for years now, and trying to understand where is the Fed looking at its own tools relative to that. And then you combine the issues of watching the war and how it continues to unfold. It is not settled yet. And that, of course, has implications for oil. So there are a number of things that I think the market is sorting out here that is resulting in the move higher in yields. And of course, we know for our federal deficit, the underlying issue is those are not sustainable, and there is no apparent plan yet for how that will be addressed. And I think until that happens, ultimately, you're going to see that kind of pressure on these longer term yields.
Do you think that the Fed factors all of this in? I mean, we're just about a week away from Jackson Hole, and this is an opportunity for Kevin Warsh to more clearly sort of communicate how he views the situation on inflation, maybe not actually outline any sort of guidance, but just his thinking. And he has that opportunity. Should he take it? I mean, if you were to call you and say, Esther, what should I do? Would you say, you know what, now's a great time to clarify because the markets are muddied on this, given all the other factors involved?
Yeah, I think it is an opportunity for him. Again, I agree with him. You don't want to be leading the markets and forecasting things that you're not able to forecast. But I do think we all understand inflation has been elevated for a long time. There have been a number of shocks hit the economy, and yet inflation has persisted. And so hearing from the Fed, how do they think about that? How does it align with their current stance of policy? I think is an important message both to the markets and the public. And I think we got a little bit of a sense of that from looking at the Fed minutes this week, where you can really begin to see where was the weight, what were the things the participants were considering as they made their decisions at that meeting.
And to that point, Esther, I mean, at this point, you know, as you point out, we've been above target for a long time, even before the war. So inflation has shown to be persistent, even beyond the inflation shocks that we've seen more recently in the past months or so. And so I'm wondering, from your standpoint, what has the cost been? I mean, there's a certain cost to not acting and allowing inflation to persist for this long. And at this point, with the shock still in place, with still the underlying inflation persistent, what is the cost of not acting? What is the cost of not acting swiftly enough in your view?
Well, I think there are several costs. Obviously, inflation is a tax on the consumer and on businesses. So it erodes their purchasing power. And that is the primary reason the Fed is tasked with keeping prices stable. The other cost, though, of this patience of sort of living with this inflation is an issue of credibility and expectations on behalf of the public. So I think the Fed has taken great comfort that inflation expectations, as they look ahead, have remained, as they call it, anchored. But those can begin to drift, and they have drifted higher. And so you don't want to lose the public's confidence that you will address this issue and return inflation to 2%. The question is when and how will you do that?
Do you think the Fed has lost any credibility?
Well, I don't see obvious signs of losing credibility, but it's the kind of thing, Melissa, I would not want to test. This is an institution that has long been willing to keep its reputation solid in terms of how it thinks about this, how it communicates with the public. So I wouldn't want to test that foundation of credibility right now by watching those expectations move. And I think that's why, if you're not addressing higher inflation with your interest rate, it's really incumbent on explaining why that is the case and what you see in the economy today that gives you confidence that holding those rates where they are is the appropriate stance.